Okay, so in this video, I'm gonna talk about Lesson 2, Revenue from Contracts with Customers, and Section 2 is about recognition of revenue over time, still under IFRS 15, and this is for CMA Part 1. So if you haven't watched the Section 1 of Lesson 2, go ahead and watch it. It's about the 5-step model of revenue recognition under IFRS 15. So just a recap, under IFRS 15, Step 5 is the revenue recognition. And under IFRS 15, we have two methods, that is the point in time and over time. So for this section, I'm going to talk about the second method, which is the recognition of revenue over time. So just for the outline of this lesson, first I'm going to talk about the criteria. When do we recognize revenue over time? Second, there are two methods of recognizing revenue over time, and this is based on the completed progress. And these methods are, first, the input method, and second, the output method. Third, I'm going to talk about the exception of recognizing revenue over time. So let's proceed. So basically, we have criteria. When do we recognize revenue over time? And at least one of the following criteria must be met. So first, customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So what do we mean by this? So common example, cleaning and payroll services. So in this type of service, for example, the customer simultaneously receives or consumes the benefits. So if I'm the entity who has availed of cleaning services, I'm actually consuming the services provided by the supplier or the seller or the company. In such case, the performance obligation or the obligation of the company, of the service company, is already being performed as they perform the cleaning services. So for these criteria, I hope it's clear. So second, entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. So what do we mean by this? So one example of this is a construction company. So when a construction company performs its obligation, more often than not, the revenue is recognized based on the percentage of completion. So in this case, the construction company performs services to enhance. So the construction company performs its obligation to create, for example, construction of a building or enhancement of, say, if there's a fit-out project. So revenue is recognized based on the completed progress of the construction work. So this is an example for the second point. Third, asset created has no alternative use and the entity has an enforceable right to payment for the performance completed to date. So an alternative use does not exist if the service provider is unable to readily direct an asset to another use. So what do we mean by this? So, for example, there is no practical restriction preventing the use of a specific asset, or if there is no alternative use for a specific asset. So in here, revenue should be recognized over time. So if a contract meets one of the criteria to recognize revenue over time, revenue should be recognized based on the completed progress of the performance obligation. So if at least, take note, at least one of the criteria is met, then revenue should be recognized over time, which is based on the completed progress of the obligation. Okay? So progress toward complete satisfaction of the performance obligation must be remeasured and updated for any changes in the outcome. So since we are recognizing revenue based on the completed progress, we must remeasure it at the end of the reporting period. So for example, if the reporting period is December 31, we should remeasure it and see if there are any changes in the outcome. So if that is the case, if there are any changes, this is treated as a change in accounting estimate, and such changes should be accounted for using prospective application. So what do you mean by change in accounting estimate? So a change in accounting estimate is usually, if there is a change in the estimate, of course, we should make an adjustment in the carrying amount. So for example, if there's a change in the revenue to be recognized, we should change the corresponding receivable. On the other hand, if there's a change in the expense and the estimate of the expense, we should also make changes to the corresponding liability. So what do you mean by prospective application? So of course, if there's any change in estimate, when we say prospective application, we apply the change in estimate during the current and future periods only, meaning we do not apply the changes in the previous or in the prior periods. So prospective, this is the opposite of retrospective. So prospective, we apply the change in the current period and the future periods. On the other hand, if it is retrospective, we apply the estimate in the prior period. So for revenue, since it's a change in estimate, any changes should be applied in the current period and future periods. So I hope that's clear. So we have here two methods to recognize revenue based on completed progress. So as mentioned earlier, in recognizing revenue over time, we actually based it on the completed progress. So how do we actually measure progress? So we have two methods to measure a completed progress. So we can measure it first through input method, second through output method. So when we say input method, so when we are performing a services, right, inputs can include, for example, resources that we consume to render such service or to deliver the goods. Another thing is the cost incurred. So another thing also is the number of hours that we render in performing such obligation. Okay, when we say output method, so it's actually a direct measurement of the value of goods or services transferred. So for example, milestone reach, for example, if it's a construction services, and so on. So actually, in determining which method to use in measuring completed progress, we should use judgment, okay? So when we say judgment, we need to apply our critical thinking skills to determine which method best reflects the transfer of promised goods or services, okay? And also, it's important that we should be consistent in applying the method. First, what do we mean by input method? So when we say input method, we actually recognize revenue on the basis of the entity's inputs to the satisfaction of the performance obligation. And we actually divide this by the total expected inputs to the satisfaction of the performance obligation. Okay, so here's the thing. When you use input method, so for example, when we measure the progress based on the number of hours that we rendered particular services. So for example, if it's a cleaning service, say for example, the expected hours to complete the service is say 5 hours, okay? And then the input there is the number of hours. Correct? The entity's input to the satisfaction is, for example, as of this moment, I have already rendered 3 hours. And then here, the total expected input is 5 hours. So what we do here is to measure the progress, we simply divide the input incurred to date, that is 3 hours. For example, I've already rendered 3 hours of cleaning services. We divide it by the total expected input, which is 5 hours. So 3 divided by 5. How much is that? In terms of percentage, that is 60%, right? 3 over 5 is 60%. So here, under recognition of revenue over time, I have already the right to recognize revenue, which is 60% of the total contract price. For example, if the value of the cleaning services is $100 or $500, I can already recognize 60% of that, okay? So we have here examples of input which we can use in measuring revenue over time. So for example, machine hours used, labor hours expended, costs incurred, resources consumed, and time elapsed. Now, the second method is the output method. So, in the output method, we recognize revenue based on the direct measurement of the value of goods or services transferred to the customer to date. Second, the remaining goods or services promised under the contract. So, for example, if I'm a retailer and I have the obligation to deliver, for example, 100 pairs of shoes. Okay, 100 pairs of shoes. So that is the output. That is the product, correct? So for example, if I have 100 pairs of shoes that I am obligated to deliver, I have already delivered 50 pairs. It means that 50 divided by the 100 pairs of shoes, I can already recognize 50% of the total contract price. Okay, I hope that is clear. So we have here examples of output methods or the outputs which we can use in measuring the progress of revenue. So for example, units produced, units delivered, milestone reached, appraisals of results achieved. So these are just some examples of the outputs which we can actually use in measuring the completed progress. So of course, we can have exception on when we can recognize revenue over time. So an entity recognizes revenue for a performance obligation satisfied over time. Take note, only if progress toward complete satisfaction of the performance obligation can be reasonably measured. So it's only if it can be reasonably measured. And this is exception. Revenue can be recognized to the extent of the cost incurred. So we can already recognize revenue to the extent of the cost incurred, meaning we recognize revenue. So for example, if the cost incurred is 100, we recognize revenue equal to the cost incurred. So 100 revenue, 100 cost. Hence, in terms of profit, our profit is 0. 100 less 100 is 0. So in this case, it is 0 profit margin. So we can do this if an entity is not able to reasonably measure the outcome of a performance obligation or its progress towards satisfaction of that obligation, meaning the entity cannot actually measure the outcome. Okay, so we can actually recognize revenue equivalent to the cost incurred. Second, when an entity expects to recover the cost incurred in satisfying the performance obligation. So for example, if the entity can actually recognize the cost, then it is guaranteed that we can already recognize revenue equivalent to the cost incurred. Third, the estimated loss must be recognized in full regardless of the methods used. So for example, in a construction company, right? So if in case there is an estimated loss, under IFRS 15, we must already recognize revenue equivalent to the estimated loss. And that is in full amount. So that ends this lesson. It's very short and I hope it's clear. Just to recap, in recognizing revenue over time, we have two methods, input method and output method. Comment below if this has been helpful to you. Comment below if you have questions and further clarifications. My name is Jane. Thank you for watching. If you like this video, hit the like, share, and subscribe. Till next time.